Okay, good evening, everyone. I hope you can hear me.
Good evening. Yes, you are audible.
Excellent. All right. So let's kick this presentation off. So our presenter today is Daniel Muthaka. Now, Daniel Muthaka is a tax consultant. He holds an ACCA, which stands for Association of Certified Chambers of Accountants. He's a part two. He has extensive work in the tax industry. Started in 2008 with computer techniques. In 2013, he was with Schneider Electronics. And now he's joined Alpha Consulting Limited. That's from 2018. Interesting to note is that his boss is here with us today. That's Wilson Kamau. Wilson Kamau is a CPAK, has a bachelor's degree in business from the University of Nairobi, and he's the founding manager of Alpha Cup Consulting Limited. So Daniel, who will be starting us off, apart from his work as a tax consultant, he has hobbies in hiking and swimming. Very important skills when you want to run away from these tax fellows. So Daniel, welcome. Say hello to the people and take us off.
Okay, good evening, everyone. I hope you can hear me. Hello.
Hello. Yes, we can. Just okay, let's go ahead.
Okay, as Dr. Karano has already introduced me, my name is Daniel Muthaka, and I work at Alpha Cup Consulting Limited. So we are an accounting firm. We specialize in bookkeeping services, tax consultancy, business advisory, and payroll services. So if I could just share my screen so that we can jump in to the presentation. Just a moment. So there, there have been some new changes which have been made, proposals by KRA, which were effective January 2024, which will affect your payroll. And what they're proposing is this. So prior to this, most of the locum fees that were directly, that doctors were earning before were subjected to 5% withholding tax. And then at the end of the year, you be able to get maybe an accountant like myself, or maybe do it yourself, or maybe go to a cyber. And those tax credits, the 5% that was withheld by your employer at the time, or which, depending on which time of the month that it was done, the 5% becomes as a tax credit. So you would have this deducted as a tax credit, then you'd account for the 25% balance. So you take your income, whatever you've earned for the year, less your expenses, then account it to KRA. So KRA has come back and said that they've just realized that most people or most institutions were not withholding the 5% on these fees, on the doctor's fees. So it's on this realization that they came up with a proposal and basically a regulation that forcing all the hospitals or health facilities to shift from the 5% withholding tax to the pay as you earn. So effective 1st of January 2024, what they're proposing is this: all the locum fees that was due to you, if you're assuming that you're a doctor, that you have a primary employment somewhere else, and you're getting locum fees from another institution, what they're proposing is this: the whatever low fees that you're going to be getting is going to be subjected to the highest pay tax rate of 35%. And in addition, they are going to deduct the housing levy of 1.5%. So that takes it to a total of 36.5% from your fees on a monthly basis. So this has pros and cons. One of it is that you don't have to worry about coming up with expenses to account for at the end of the year, so that you can be able to lower your tax liability. This, you only get a P9 form from your employer or the several employers that you have during the year, and you simply account for these taxes that have already been withheld at source at that point. So you just file your return at the end of the year and there's nothing else to pay. The drawdown is this: from whatever fees that you are being deducted, from a low of 5% to as high, it will go up to 36% of your fees. So this, at the end of the day, affects your disposable income, because government is taking away 36% of your salary, of your fees. So that is a new development, and this is how it will look like. So assuming in a month you pay out, you raise you have fees that you've raised to one of your patients in any of the institutions of maybe $1 million. So government is going to take out 35% of this in terms of pay, which will come to about 350,000, and add to that another 1.5%, which will go to which will come to about 15,000 to go to the affordable housing levy. So this means now that your deductions now will come to 365, and your take home at that particular point will be 635,000. So in the initial 2023 going backwards, your take home, if you had done $1 million, they would simply have deducted the 5% and you'd have taken home 950,000. So the 5% would have represented 50,000. 950,000 is your take home. Then you account for that at the end of the year, if anything. So you come up with expenses, deduct the balance, you calculate 30% of that, and you take it and you pay KRA. But now they're saying now we want that to be done on a monthly basis, and we want it to be done at the highest rate of 35%, plus the 1.5% levy. So this, up to this point, I'm only catering to practitioners in your field who are getting their fees as individuals. So this is the impact that it has. For entities that for doctors who have registered themselves as using their entities or invoicing through their entities or companies or private practice, then it becomes a whole different ballgame. Right now, the Finance Act has made it compulsory that all businesses have to register on eTeams. Now, there's a new regulation that was done in the past week that excluded anyone who is earning less than 5 million. Any institution or any business that is earning less than 5 million, there is no need for you to register on eTeams. But anyone who's earning that, so anyone who's has a private practice and is earning more than 5 million, you'll be required to register on eTeams before 31st of March 2024. So the new regulation says they've given a grace period. So it starts from 1st of January this year up to 31st of March 2024. That is the last date that they'll allow you. If you anticipate that you're going to be making 5 million, or you know you're making more than 5 million as an entity, you need to register yourself on eTeams. So this now changes everything now. So if you're invoicing yourself, you're invoicing your fees as an entity, at the same time, you'll be required to get eTeams for your expenses. It means now all your expenses that you book under your entity have to be eTeams compliant. So it means your suppliers or your service providers, you have to request them to be giving you eTeams invoices for you to be able now to be allowed to deduct those expenses under your entity. but there are certain exclusions. So not all expenses are subject to the ETIM's regulations, and these are salaries, anything that you import, whether goods or services, investment allowances. This one touches mainly on depreciation. And then if you do a travel, airline passengers, so either local or foreign, those ones are exempted. Your interest income or expense that you book as an entity, those ones are exempted. Bank charges by any financial institution, those ones are also excluded. And any expenses which are subject to withholding tax, that is a final tax, those are also expenses. Those ones are also excluded. And this on the last point where it says suppliers who are resident persons who are earning less than 5 million. So if you have any supplier who is earning less than 5 million, they do not necessarily need to give you an ETIMS invoice as per these regulations. But it's something that we are waiting for this space because KRA have a tendency of changing regulations here and there. So, but this covers the small SMEs that will give you services or goods to you, and they do not necessarily need to have you. So petty cash items, so to speak. And I think that is the end of my presentation. I've made it quite short. I wanted to give space to the Q&As or any concerns that any of the members has, so that now we can be able now to take it up from there.
Okay, as the members prepare their questions, one or two clarifications.
Yes.
So first of all, you said all businesses
Yes.
will be required to register in ETIMS unless they are earning less than 5 million.
Yes.
Is that 5 million a month or 5 million a year?
5 million a year, 5 million annually, 5 million a year. So it comes to about 400,000, 460,000 in a month.
Okay, and then
So,
secondly, with this ETIM system,
yes.
or actually with the locum that you talked about, where whatever we are earning is being subjected to 35% instead of 5%. Now, what happens to the expenses in that system?
There are no expenses. That is a one-off. So this is assuming. Now, let me take you back. With the locum fees, they're assuming that you have you have one main employer somewhere else. So it's not something that you earn on. It's your main source of income. But if it is, then the institution that employs you or engages you for services for locum will be, as far as the locum system is concerned, they will subject you to 35% of tax and the 1.5% housing levy. And it becomes final. You don't have to do anything else. So whatever you take home is final, and it's for you now to do as you please. I don't know whether I'm clear. Dr. Karan?
Yes, that's clear. Now, there's what they're trying to one of the questions that's come up from the group is you need to define between a locumer and a consultant. So what we mean by locumer is you may be employed by Kenyatta, but
Okay.
over the weekend you go and work at Nairobi Hospital.
Okay.
And then we have a second group that are consultants. So you're working wherever you are, but you have multiple patients that you admit in multiple hospitals. So what happens to that?
Same concept, because at the end of the day, it depends on who is accounting for this pay. So assuming you have company A that is employing you, not company A, let's assume there's a doctor who's working at Kenyatta National Hospital and is getting consultancies from one or two patients that is going to refer to other institutions. And the sound is a bit distorted. Okay, sorry. Okay, so assuming there's a doctor who's employed at Kenyatta National Hospital and there's a high, the same doctor is providing consultancy services to one or more institutions under either locum or consultancy. The law stipulates that those are going to be treated at the same way. So the institution, if there's a company A and company B, which is giving you, company A is giving you locum fees, and company B is giving you consultancy. That company or health institution that is giving you locum and company B, which is giving you consultancy, are liable to deduct 35% and basically the 36.5% of the fees that they're going to give you.
Hello.
Hello?
Okay, I have two questions.
Okay.
The first one is in regard to the income itself.
Yes.
Sometimes we are paid for the work we do fairly late. So for example, I wanted to ask about income earned in 2023.
Okay.
Would it, and it's paid in 2024, would this rule apply immediately? Or can it be argued that this money was actually invoiced in 2023 and therefore doesn't apply? Then my second question was in regard to now individuals who have registered themselves into what you called companies or partnerships.
Okay.
Are we then subject to the same rule, or as a company or a partnership, do we just need to register on e-Teams and then expense before finally being taxed on our income?
Okay. Let me answer your first question. If it's a 2023 income that was invoiced in 2023, I'm assuming you invoiced as a company. Then
No,
this
as an individual, yes, but in 2023. However, all the doctors here will tell you there's money they even before 2023 that they have invoiced that has actually not been paid. So now we're in 2024. There's a new rule, and then I'm being paid for 2023 income. Will the rule still apply to that money? Will it be taxed at 35%?
No, technically it's not supposed to be taxed at 35%. It's supposed to be taxed at 5% because it's more of an accrual. So the services were offered in 2023 or prior to 2024.
Yes.
So the invoice was already raised, they have already booked it. So they're supposed to subject it to the 5% tax and give you the balance of it to account for it yourself. Because at the end of the day, the 2023, if you're doing an accrual system, the 2023 income, you're going to do it in your annual return in 2024 by June to account for those.
Okay.
So that applies technically, you're supposed to be paid that less 5%. Then you come up with expenses. The difference now, you calculate now 25% of that. Now you give it to KRA because they have already deducted the 5%. So ideally, that is how it's supposed to be done.
Okay.
For 2023. Now, for companies or partnerships that invoice fees that you'd call, I think in your space, called consultancies, then the 35% will not apply to you. Because remember, the 35% is an individual, it applies to individuals, employees. So it will not apply to entities or partnerships. Those are separate entities as far as the law is concerned. So for companies, what will happen now is the 5%. So because you're providing a service, but you're providing it through an entity registered, and I'm assuming here it's a duly registered entity or partnership with the registrar of companies, DRS. So you'll be subjected to the 5% of whatever invoice that you're going to raise, and they'll pay you the difference. But now, if you're making more than 5 million as an entity, you'd be expected to register on e-Teams as that entity yourself, not as the doctor.
Correct. But in that case, still the rule will apply that the tax will be paid when the payment is actually made. Correct.
Yes, yes, yes. So withholding tax.
So it doesn't matter that I've invoiced. I've given an ETIMS invoice. I will still pay the tax when the company is paid. That's what is that clear?
What do you mean when you'll pay tax when you are paid?
For example, let's use a big corporation like Safaricom.
Yes.
They only pay tax when they declare their annual income, correct? Not when they invoice different companies for services they are provided. They will actually pay tax at the end of the year on the actual income they received.
What you're referring
Does
to
this
is
still apply to a partnership or a company that is providing medical services?
it applies. So what you're referring to is what we call corporation tax. So the 30%
Yes.
corporation tax.
Correct.
So 30% corporation tax is normally paid 4 times in a year. So they normally don't pay it at the end of the year. What they do is declare. But
Yeah.
what happens is, ideally, as per the law, you're supposed to do 4 installments in a year. So
That's
assuming
the turnover tax.
no, turnover tax is done on a monthly basis.
Okay, that's different. Okay, thank you.
That's different. That's very different. So what you're talking about is installment tax. So say, assuming you anticipate, so you're going to make about 100,000 in tax payments by the end of the year, for argument's sake. So 100,000 divided by 4 is about 25,000 on a quarterly basis. So as an entity, if you anticipate your revenues and your expenses are going to be the same throughout the year, you'll be expected to pay 25,000 on a quarterly basis up to the end of the year. So KRA expects you to pay that on a quarterly basis, not at the end of the year. So you pay the first installment tax is normally paid on the 4th month, which is normally, if I follow the calendar year, is normally the 4th of April, 20th of April, sorry, the 20th of April. So that's the first installment tax. The second installment tax will be due on the 20th of June. The third one will be the 20th of September, and the fourth one on the 20th of December. And then if there is any, say for example, assuming you're going to make more profits, there's still an opportunity for you to pay the balance of tax by the 30th of April of the following financial year. So it's normally 5 payments cumulatively. But if you anticipate you're going to make a loss, then you are not liable to make those installment payments during the year. So depending on how you performed.
Sorry, I'm asking a lot of questions. Based on what we have discussed about companies or partnerships,
yes,
would it then be a good idea for us as doctors to coalesce into more or less partnerships to avoid this whole 35% tax issue?
Yes, it's a structure that you can adopt, so that you can be able to navigate this. But at the end of the day, sorry, come again.
Kindly mute your mics. Somebody's mic is hot. Thank you.
Okay. Going back to my earlier question. So to the earlier question that you were asking, yes, it's possible to come up with a structure, a partnership structure that would be able now. That means now you have to register an entity on its own. But at the end of the day, that partnership with the number of partners that are going to be in that partnership needs to register for ETIMS on its own as a legal entity. So that now from there now, whatever income that you're going to be generating or whatever invoices you're going to be raising is going to be subjected to the 5%. Then from there, you can be able to come up with expenses, allowable expenses, so that you can be able to reduce your tax liability to KRA at the end of the year.
Okay, thank you, Dr. Okubo, for your questions. Now, so let's all mute our mics, please, if we can. Now, as we as we proceed, Daniel, I hope you can see the questions in the messages box. As you're looking at those, I will ask your boss, Bana Kamau, Wilson Kamau, Karibu, say hello to the audience, and give us some more information if you do have any. Thank you.
Okay. Thank you so much for that introduction. Thank you, Daniel, for taking us through the presentation. Much appreciated. As mentioned, my name is Wilson Kamau. I run Alpha Cap Consulting Limited. As Daniel mentioned, we are a bookkeeping firm. We specialize in offering part-time accounting services, tax consultancies, and advisories, and also payroll. So basically, we help people, individuals, businesses, small businesses, doctors, clinics, just be able to be compliant, especially when it comes to sort of bookkeeping, taxes, ensure everything is done properly, and so that you don't have to worry about the taxman coming for you. I think the very good questions that are being raised here by the participants, and I welcome that. I think just to add to what Daniel had mentioned earlier, so I think there's a comment here that somebody said that, is it then easier then to run as a company and as a partnership to avoid this new regulation? So you need to, so let's look at it on a practical basis. So when you run it as a company, what would happen then, you bill as a company, and then you will charge, then the person, the facility or the hospital that will pay you will withhold 5%. So then you'll get 95% into the company. Now in the company, you are allowed to take out expenses, and then whatever remains, you know, subjected to corporation tax. Now in this instance for companies, the corporation tax is at 30%. So you need to balance and see whether, for example, if you do it in that particular method, would you be saving more? How would you be saving more? Or will it be easier to go it as an individual? Why I'm saying this is that as a company, you can't, when you bill as a company, you are independent from, the company is independent of you. So if you as a doctor want to take out money from your own company, you also have to pay as you want. So you can't go to your own company and just take out the money. So if you take it out from the company, you have to pay as you want. But if you can actually pay for running expenses. So if you are working out from an office space, if you're working out from somewhere you've rented, or you have running expenses, you rent, telephones, stuff that are a business that are allowed expenses, you're allowed to take them out, and then whatever is left out, you now can pay tax on that, and then the rest now you can pay yourself as dividends. So it's good to see that balance and see what would work practically for you.
Let me jump in with the questions that have been posted. Let me go one by one. What is the difference between a locama and a consultant? As far as taxation is concerned, both of you are providing services. So as far as the taxman is concerned, this is going to be subjected. The new regulations require that the health facility or the hospital that you're working under, especially if you're an individual, if you invoice as an individual, you'll be subjected to the 36.5% of payee and how affordable housing. So I hope this is clear for this question. And then I think the second one I'd already answered. If your annual income is more than 5 million, that has also been addressed widely by Wilson, my colleague. What about cost of expenses such as fuel when filing for tax on the locum extra income as an individual? Now, this is what I had mentioned earlier. If you're invoicing as an individual, fuel is part of the allowable expenses that you can be able to deduct. Though the Finance Act as of 2022, as 2023, sorry, there is a section that addresses this, and for you to be claiming fuel and as an individual, you need to be registered for payee. which is a bit complex and a bit tedious. So what they are asking is, you need to be claiming mileage allowances for this. So basically fill out a mileage and a mileage sheet that says that you will travel from point A to point B for this particular service that you're offering to one of the patients or one of the health facilities. And the rates that you're going to be using is going to be the AA rates. So what the government is trying to do, or is trying to do, is streamline the way transport expenses in general can be able to be recouped, or basically to be allowed by most institutions across board, whether you're an individual, a company, or a partnership. Withholding tax. Withholding tax for professionals was not repealed. It's still there for any professionals. It's just that this time round, KRA, in an ad hoc manner, decided to target the professions of medical practitioners, so that now they can get more money out of professions. So I don't know whether maybe they are going to go after lawyers or maybe contractors. But for now, as it stands, they have gone for the medical practitioners, and they're saying that the fees that you're providing need to be subjected to pay. And the rationale behind it, what I'm meant to understand is that the services that you're providing is a core service that you're providing to the health facilities. So without the services of the doctors or the nurses, and in your case, orthopedics, the facility cannot run or cannot offer that service. So what they're saying is, this is a primary service that is being offered by the institution, and in turn, it needs to be subjected to pay, not as 5% withholding tax. Next question. Lawyers are not subjected to, I believe I've answered this. Lawyers are subjected to withholding tax 5% when they're offering their legal services. So are even ourselves as accountants, we are subjected to 5% withholding tax. Contractors, your architects, they're subjected to the same. So it's only doctors who have been made as a special group. And I believe some of you saw there's a communication by one of your, I call it sister associations, KMA, who are objecting to this because they found it discriminatory that it's only the professions, the doctor's profession, that are subjected to PAE. So we see how this is going to pan out going forward. But for now, it's just the doctors who have been subjected to this PAE when it comes to the locum fees. It sounds like you get more money if you get paid as a company than as an individual. Yes, at that point, you get more money as an individual, but as Wilson has explained, you need to assess the impact, or whether it's called economic, it will make more economic sense to be as a company or as an individual, to have more expenses so that you can be able to pay less to the government at the end of the day. Because please remember, 30% corporation tax is 30% of your net profit. So you need to have income, allowable expenses, whatever difference that you get from there is what now you pay 30% corporation tax. So you need to assess, and especially for the service industries, the only way that I have seen so far in my experience that you can be able to take out money from your company is through a salary. Otherwise, it becomes a bit hard. KRA will be on your case because they know you have to make a living, and you have your own personal expenses. So you have to say how you'll be taking out money from your entity. What happens when eventually the company partnership pays the doctor? So this again, to my earlier point, the entity, if the company or the partnership, if you decide as doctors to partner together so that you can be able to evade this 36.5%, you will not be necessarily evading it. It will find you on the other end. So it depends on how you structure this. So if you decide to go as a company or a partnership, For you to pay yourself as a doctor or as a partnership or as a partner, if you're one or two partners in that partnership, you'd have to register with for pay in the partnership itself, and also register for NHIF and NSSF, and housing levy becomes automatic. So all those things you're going to be paying under that entity to yourself, so that you can be able to say at the end of the day, this is the much that I'm making. So it's all about planning and structuring and seeing which is the best route for you. Dividends paid to the doctor from his company are subjected. There's a 5% withholding, the final tax that is subjected to dividends that are paid from an entity. So if you choose to pay yourself dividends from a company, it is subjected to a further 5%. That is after paying 30% corporation tax to KRA, then another 5%. So the difference now, you can be able now to pay yourself as a doctor. What if the money from the company is dividend on shares owned? Does it necessarily have to be termed as a salary? No, it becomes a dividend on its own. So, question from Dr. Okum. So this will not be classified as a salary. It becomes a dividend. So at the end of the day, so it's how well you structure yourself. If you're ready to pay the 30% corporation tax to KRA against the profit that remains after deducting expenses, you can always pay yourself a dividend, but remember the dividend is still subjected to 5%, and you have to pay this to KRA. I don't know. Any more questions? I believe I've answered. Is there any question that I've left out?
Yeah, there's a question there about the difference. There's I think still Dr. Okumu asked, kindly explain the difference in tax terms between a limited company and a limited liability partnership. I believe that for an LLP, tax requirement is better. So, okay, let me also I can take that as people add more questions. So in terms of a limited, in terms of accounting, for example, for both an LLP and a limited company, it's pretty much the same. So as I said, it's all a business. So what you do is you prepare you book your income, whatever you get from your facilities where you're working, you're consulting. Then you're allowed some allowable expenses, and whatever is left is your profit or what is now subjected to tax. Now, for the difference between the two is that for a limited company, it's subjected to 30% corporate tax. It's a flat fee. It's a flat fee. So what happens is that if you make 100K, for example, in net profit, 30% goes to the government as taxes. That's 30,000. Then the rest 70,000 you're left with as profit for the company. But now, if you want to take it out as a director or a shareholder of the company, you take it out as dividends, and that now is subjected to 5% withholding tax. So you take out 5%, 70,000, whatever is left now, which is now 66,500 is what you can now pay yourself as a shareholder of the company. And that's your money, and there's no further taxation to it. Now, for LLPs, a limited liability partnership, they operate like a normal partnership. The only difference between an LLP, a limited liability partnership, is that one partner has a limited liability, and that is the partner who's the managing, most of the time, the managing partner. So an LLP tax laws is just similar to a normal partnership. But in a normal partnership, what we do after taking your income, removing your allowable expenses, whatever is left as your profit or your partnership profit is shared among the partners in the profit sharing ratios. Now that whatever, so for example, if you're in a 50-50% partnership, and so you make 100,000 in profit for the year, 50% goes to one partner and 50% goes to the other partner. So you get 50K each. But now that 50K is what you declare as your income for that year. So in declaration for in declaration of that income, you pay income tax as an individual. Paying income tax as an individual is like what you say is like payee. So it's a graduated scale. It's not a flat fee. So you as a partner will declare the income you've made from your partnership and pay payee rates on that income on a yearly basis. So I hope that's sort of clear. So if you look at it practically, you'd rather operate as an LLP. Definitely it's cheaper because the pay rates are depending on how much you earn. If you earn upwards of 800 times 12, up to 10 million in income in a year, it's cheaper to be as a LLP as opposed to a limited liability company. That's what I'd recommend. Yeah. Then Daniel can go ahead.
I've seen another question by Elizabeth. What about an hospital consultancy? Is it grant writing for NGO by individual consultant? Grant writing, I would assume this is outside the scope of individual consultant. This, as far as this is still a professional service, I would like to assume that you're offering this service as a consultant to the NGO. So the NGO itself will not subject this. So you don't become necessarily a doctor or a medical practitioner in this case. So for this, it will be subjected simply to the 5% withholding tax. And the balance now you can be able to take care with the other expenses at the end of the year. So that now you can pay the balance to carry, if any, when doing your annual returns by the 6th month or June after. If a company raises an 18th invoice, KRA will treat this as an income to the company. Suppose the paying facility pays less than the invoice amount or doesn't pay at all. Now, in this case, if you raise, there's an option of raising a credit note for this, for the balance that was not honored by the company. So if you believe at one point or the other, because at the end of the day, you have to demonstrate to KRA, or if you know for sure that this company is not going to honor the dues owed to you, there's an option of raising a credit note on e-teams, because it doesn't necessarily mean that once you raise the invoice, that is the final. Things happen along the way. So if you establish along the way that your employer or the hospital is not going to honor its due against your invoice, you can simply raise a credit note to offset whatever balances have not been paid to you, so that now you have the right income that you declare as a company to yourself. Will the secondary employer be required to make an income contribution or housing levy for the locum? Yes. So the secondary employer will be required to make he'll be expected to match the contribution. So now this is where it comes in. It becomes a bit taxing now on you, the locum now. So if you have several employers who are deducting you 36.5%, it means you have housing levy equivalent to the number of locum services that you offer or consultancy services that you offer as a doctor. So each secondary employer is expected to match the housing levy as far as the invoices that you raise as an individual to them. At what point can the individual claim the mileage? Now, the mileage is an expense. So if you've registered yourself as a company or a partnership, the mileage becomes an allowable expense to you for you to be able to reduce your tax liability. Please remember, when you're registering yourself as an entity or a partnership, you're invoicing your income. So you have income less your expenses. So your travels, your fuel cost, your mileage allowance, internet, telephone, those and the mileage, those are consolidated together, so that now you less all your operating expenses for doing or offering that service, so that you can be able to get a net profit. From that net profit is where now you can be able to deduct now the balance. Please remember that the 5% that you've already been deducted before at source when the payment was being processed it becomes a tax credit on your ledger on iTax. So what you'll simply pay for is 25% of the net profit that you've already declared. That is what you'll pay to KRA. So it will not, the mileage will not necessarily be refunded against the 35% pay. The 35% becomes a final tax on whatever has already been deducted. And you don't have to pay KRA anything more by the end of the year. Is there a retirement from paying income tax, or you have to pay until you die? You only pay income tax when you have an income. So if you're an individual, it means you're employed by you're employed somewhere. So with these new regulations, if you stop offering your services either to the primary employer or to the secondary employer, your obligations to KRA end at that point, because you're only registered for income tax. You're only liable if you're earning an income at that point. So if you do not earn any income in any particular year of income, even if it's before retirement, you're expected to be filing new returns. And also that's what most people have been doing in the past. So it doesn't matter. So if you don't have any form of income going forward or at any point between now and in the future, you're expected to file an annual return until you die, basically. Let me paraphrase what is the words you've used. Any other question I can be able to take, or any other that I missed that I should take again?
So I think so far you've answered quite a number of questions that we had.
Okay.
And sounds from what you people are advising,
Yes.
for those who are earning money as in private practice out there, sounds like that company is a safer way to go. I don't know whether that's what you're advising.
Yes, company would be safer, but it's how you structure it. So at the end of the day, you need to be prepared to register for these other obligations, because once you've registered your company, it means now you have many obligations as an entity. So you'll be earning your income, but you need to look for more allowable expenses for you now to be able to be deducting, so that you have less profit to declare at the end of the year, so that you pay less corporation tax to the taxman. So it's how well you structure yourself. But at the end of the day, because all of you are in the service industry and more so in the medical space, your services, the services that you offer necessarily do not have as many expenses as from my own experience. So as Wilson has mentioned, if you choose to go the company way, or if you choose to go invoicing through the company, please be prepared to register yourself for payee as an entity, and also for NHIF and NSSF. And please remember, NSSF is going up. It's at 6% at the moment of your gross salary, but it's capped at 1,080 as of this month. But next month it will go up to 1,740 for anyone who's earning above 36,000. That is for NSSF alone. NHIF is still in discussion. It's still at the parliament, but the proposal is 2.75% of your gross salary will go to NHIF, which for me, in my own opinion, does not make any sense. For anyone who's earning above $500,000 in a month in, say, salary, if you do 2.75% of that salary, it comes to about just a moment. It comes to about 13,000 on a monthly basis. You multiply that by 12, that comes to about 165. That is a normal basic medical insurance that you get from a private facility, private insurer here outside here in Kenya. So for me, anyone who's earning above that, it really doesn't make any sense for government to be taking that much money from them. And at the end of the day, you're only limited to go to a public facility. So it's a wait and see as to how government is going to implement this. But at the end of the day, I'm sure they're going to cap it. But for you, if you register as a company, please be aware that all these other obligations, you have to register yourself as an entity within the entity itself. Pay, NHIF, NSSF, and housing levy.
All right, thank you very much, Bwana Daniel Muthaka. So I think, as you've all heard, there are changes we need to make. And in the past, we used to do our own taxes individually, but it looks like we will have to look for tax companies. So Wilson Kamau, please tell us where your company is found as we conclude this.
Thank you so much, Dr. Karanja. Karan, sorry. Karan, sorry. So our company is based in Tome, along Thika Road. You can find out more details from our website. I'll post the link on the chat. It's alphacap.co.ke. So you can find out more information about us. And also, I'll also leave my phone number there in case you need to reach out to me. If it's possible, you can also share with us a list of the participants in terms of their email contacts. If they wish to be contacted, we can send them information about this session today and give them more information. And in case they also need to reach out to us, we can give them more information. But as I said, we are found in Tome. You can find out more information from our website, and I'll also post my number on this chat so you can be able to reach out to me. Yeah. Thank you, Dr. Karan.
Okay, thank you all, and thank you to all the participants. Wish you all a good night. Asanteni sana.
Also, thank you so much.
Mm.